The top 5 terms that you'll need to know about bonds or fixed income securities. If you're applying for a job with a hedge fund or a bond fund, these are the 5 key terms. The first one is zero coupon bonds. What are zero coupon bonds is a question that is often asked because we all know what are coupon bearing bonds. So coupon bearing bonds are those but pay coupon at predetermined intervals, and in fact that is the most important feature of the bond. So then what is a zero coupon bond? Make sure your answer comprises these 3 statements. They are issued at a discount to par value. They pay no coupon to the investor. The issuer doesn't pay a single dime as a coupon. And it is redeemed at maturity at par value. This means that the bonds do not pay coupon during the life of the bond. What is SOFR interest rate? Well, most of our textbooks have taught us about LIBOR. Many of us have understood the meaning of LIBOR, but we may not be familiar with SOFR. SOFR stands for Secure Overnight Financing Rate, and this is a reference interest rate for US dollar denominated floating rate bonds or notes. It's in fact an overnight rate. If you want to show off your knowledge, definitely tell the interviewer that SOFR is a replacement for LIBOR, even though there are stark differences in the calculation of both of them. Senior and subordinated bonds. The third question. Senior bonds are bonds that are typically having collateral backing. Okay, so see that you clearly distinguish between senior bonds and subordinated bonds. Don't give a garbled answer. Let's see how the clarity comes in. Okay, a senior bond is one that is backed by collateral. Coupon rates therefore are generally lower on senior bonds, and in the periodic claim stack they start at the very top. That is, in case a company goes bankrupt, the senior bondholders will be paid out first. Now let's go and understand what is subordinated debt. Subordinated bonds are unsecured, and because there's no collateral backing, they generally earn the investor a higher coupon. And because they are unsecured, at the time of bankruptcy, they are paid after senior bondholders are paid. So they are lower in the priority claim stack. So make these 3 distinctions extremely clearly. The fourth point, what are call options and put options? And no, we're not talking about futures and options trading. We're talking about call and put options in bonds. Again, be very clear. A call option is when the issuer redeems the bond, okay, before the maturity date. So what's the option about it? The option is that the issuer can redeem the bond before the maturity date. In a volatile interest rate environment, the issuer might want to exercise that choice. Put option is when the investor wants to exercise an early redemption. So the difference between a call option and a put option is the call option is redeemable at the issuer's choice, and the put option is when the investor gets to choose whether to exercise early redemption or not. And the final point, what are bond yields? In fact, if your question on bond doesn't ask you about bond yields or bond returns, then there's something wrong with the interviewer. In fact, you must go and tell them about bond yields. Bond yields are the returns to the investors. Different bonds are traded at different prices compared to the issue price. The yield is thus calculated as the coupon that is earned on a single bond, and the denominator is the price. As the price increases, the yield will decrease, and therefore low yield bonds have a high price. And why do they have a high price? They therefore considered to be safe. Okay, let's test our knowledge. Which of this is right? A, SOFR is a stock market index. B, SOFR is an interest rate index. C, SOFR is used for pricing floating rate notes. D, SOFR changes every day. So I have A, B, C, and D all related to SOFR, that's the Secured Overnight Financing Rate. And the options given to me are only A is correct, both B and C are correct, or B, C, and D are right answers for describing SOFR. Okay, so we're talking about the different features or the different characteristics of the USD interest rate. Only A is correct, B and C are correct, or all 3 are right. Thank you for watching this channel. If you like the content, subscribe and share.